What's up? What's up? What's up? What's going on, Worship Leaders Plus investments and financial finance? What is the name of the group? I have no idea. It doesn't really
Worship
matter.
Leaders Plus Investing and Personal Finance.
Yeah, and I put that name together, so I have no idea why.
So you should know it. You
I
should
know,
know it.
I should know it by heart. But all right, everybody, we already got two people watching us. These poor people have to endure us. But if you guys want to join up, you can hop in conversation with us. So you could ask Dave, or maybe you can share your thoughts and ideas. You know, Dave and I started in September. He's obviously more technical than myself because he just dove in like crazy. I'm riding their coattails, which is kind of, they'll probably tell me that's dangerous. Your money is on the line. You don't be dumb.
Yeah, don't follow. Do your own research.
Do your own research. It's got to be DYOR. That's got to be like the tag for this
Hashtag
group.
or something. Yeah.
Hashtag DYOR. Do your own research, dummy. Right? Like we should do DYORD, like or S,
something like that.
Dyors. Anyway, guys, if you do want to jump in, it is live.lemdrops.com, and we have with us Dave Nowlett. We've known each other only in the Facebook space, so he's going to share a little bit about himself, what he does, and all that stuff. But before he does that, you guys don't know me. My name is Lemuel. Welcome. This is our first live stream. Tyree and Pastor Jamal went live the other night talking about Forex and also resistance strength index or those technical terms that I'm just starting to learn 8 months into my investing situation. But anyway, I started investing back in September. I got several. I'm fairly diversified in the way that I do my investing. I do daily trading through Ameritrade and also Robinhood recently in April, crypto, which I should have started in November because then your boy would be a millionaire. But anyhow, and I also have long-standing investments. I think I'm just referring back to the post that you just posted between trading and investing. So I do that through Acorns, and that I just do a weekly deposit there.
Yeah.
Anyhow, that's me and my investing. So with that said, Dave, share to us who you are and your investing journey.
Yeah. So I'm Dave, and I started, likewise in September. And really, the thing that excited me about it was the idea of having my money make money, having my money be productive for me. But I'm not really a gambler. I don't go to the casino, play cards, pull the slot machines, any of that kind of stuff. So my whole thing was, what is going to be the safe place for my money where it's gonna appreciate over the long term. And so what I've found is essentially a long-term investing, I don't know if you want to call it strategy idea. I tend to target companies that pay dividends. And so if you don't know what a dividend is, essentially it's a company has excess cash that they've earned. And in that excess cash, they've decided, we don't have enough places to reinvest this excess cash. So we're going to turn some of this cash over to the owners of the business. And, so my biggest focus is on these companies that are, that are focused on paying a dividend, but then also increasing the dividend through healthy measures. Because typically, if they've got the means to increase the dividend, because they're growing their cash flow, they're investing their profits wisely, that means that this is a company that's going to grow and improve over the long term. And so that's really the goal here with it.
So question, Dave. Does every company provide a dividend resource, or what would you call it? A dividend option? I guess that would be
no, not every. It would just be a dividend payout. Not every company offers it. For instance, Warren Buffett's company, Berkshire Hathaway, is, I mean, Warren Buffett's one of the most famous investors of all time. And Warren Buffett's company is notorious for not paying a dividend because his point of view on it is we have better reinvestment opportunities that are going to grow your money faster as an investor.
Okay.
And so when you look at it, like one of the more popular dividend stocks among the dividend community, for lack of a better word, is something like Coca-Cola or Pepsi. But the reason that I don't grow or I don't invest in them is because if you look at how much of their cash they're paying out close to 80% or more of their cash flow in dividends to their investors.
Oh,
And so that means there either isn't opportunities to grow the business, or the only opportunities that they have to grow the business are via acquisitions. And so, I mean, you think of Pepsi and Coca-Cola, they're pretty much known commodities around the world. There's very few markets that they're going to be able to, penetrate into. Whereas a company like Apple pays out, I believe the last time I looked, it was maybe 18% or so of their money in dividends. And Apple makes more money than most countries, So they've got a ton of money. They're reinvesting it into the business, and then they're able to continue to grow the business while also providing value to me as an investor. And so, dividends are one way that they can provide value. The other way is via share buybacks, which, if you look at principles of supply and demand, a company purchases their shares from the open market, and now instead of there being 1,000 shares available, there's only 500. But the company itself is still worth the same value. So obviously those shares should go up in value.
Very interesting, man. You, in the length of time that we started, and it's funny because we all kind of started in the same journey, and you, Tyree, and other folks, you guys are so technical, and that's the reason why I am not here by myself. That's why you are in this conversation. So let's do this, bro. I know you got some things to share with us, but before you do that, tell us some of the applications or the software or the platforms that you're using in order for you to do your investing. Or I know you don't trade, so and there's a difference between that, and probably talk about it in another live. But just talk a little bit about the platform that you're using, and maybe if you have a referral system on that, so that we can.
I've got the platform I use is M1 Finance. And the reason I like M1 Finance is that it's really geared towards somebody who's a long-term buy and hold investor. And so what I mean by that is, most brokerages, charge fees and things for trading and different things like that. M1, you can only trade once per day, but I don't have to pay a fee to actually trade and invest in these different companies. They do offer other services that you can pay a fee to take advantage of. But what it essentially allows me to do is I can pick a whole group of companies, and I can build them up into what they call a pie. And so I can designate, I want to have this much of my money allocated to the technology sector, for instance. And then I want that divided up between, say, Apple, Microsoft, Intel, Broadcom, whoever the case might be, AMD, and you basically can build your own ETF. For those of you who don't know, those are the exchange traded funds. It's basically a basket of stocks. They're normally measured against the index. And so you can essentially build your own ETF, and then in building your own ETF, if you turn on their auto invest feature, every time you add cash to the application, it'll just automatically buy whatever is undervalued in your pie. So it's a cool system that allows you to stay invested and keep within your target allocations. I don't typically leave auto invest on because I'm looking for what is my best value, regardless of if I've already got a lot of Apple, I'm going to buy more Apple.
Yeah, you know what? We'll probably go and kind of break down. We'll probably have a chance to break down for folks some of the platforms that everybody kind of uses. But I'm just gonna go and showcase a little bit of the M1 website anyway, the back end here.
let me grab. If you give me a second, I can give you a link, and you'll actually see. You can see how. Let me grab this here real quick. Share pie, copy link. I'm gonna send it to your Facebook here.
Sure.
And so that's actually going to be a live look at what my target allocations are within M1 Finance. It doesn't mean that I'm allocated there. And I can actually even explain, if we want to open it up here, I can explain the reasons why I've made some of the selections I've made as I've learned a few things. I've kind of changed some strategies and simplified some things as far as life goes.
Yeah, I'm looking. I'm about to open up the thing that you sent me. Give me just 1 minute. So this is this. Is it a browser based like PC Mac only, or
yeah, PC and Mac, and then there's
app?
a phone app as well. Yep,
There
there's a phone app as well.
Okay.
Mm-hmm.
And we're not going to necessarily break down M1 here, but we do want to familiarize people with what you're using, so that when you do talk about it a little bit, people have a little understanding about what's happening. Yeah, so let's go to the other one here. Chrome.
And so they have what they refer to as expert pies. So these are like Warren Buffett, for instance, has to divest via, I believe it's called a 13F form. He has to dictate every quarter and tell you what he's invested in, what percentage of his allocations are in which. And then M1, if you wanted to invest in Warren Buffett's pies, you could actually go ahead and invest in everything that Warren Buffett has, and then whatever he buys and sells, your allocations will be marched up to match that over the quarter.
So is this your allocations?
These are my current allocations, yeah. And so passive income and long-term growth are my goals with it. So that's just kind of what I named it. And so you can see I've got a few different sectors. The largest sector there on the top is the equity traded funds, or the ETFs. And the reason I've got that at the largest allocation is, honestly, it's just hard to beat the market in the long term. I was watching a video the other day that showed that the S&P 500 has returned an average of 9.8% annualized over the last 30 plus years. But most investors have returned 4% or lower. And that's because there's a theory that's referred to as the market inefficiency hypothesis. And essentially it says that, or the market efficiency hypothesis. And basically it says it's impossible to be more efficient than the market. And so by holding each one of these funds here is tied to a different underlying index. So like SCHD is tied to the Dow Jones Dividend 100 Index. Okay. And so what they do is they have a system that reviews the different companies and it weights the different holdings in there accordingly. And then in weighting the holdings, they'll actually initiate buys and sells within the fund, but it doesn't matter because I just hold the fund.
So a question,
and then they provide dividends on a quarterly basis out of what those companies pay.
So a question is, so for your method of investing at this present time, you're really not looking to cash any of this out. This is long term. When we talk about long term, how many years is that? What are you talking about?
I mean, ideally, I may sell, like I've sold some positions to fund other positions, but my goal is to never take the money out of the account and eventually get to a point where I can just cash my dividend checks and let everything else keep riding and let my money keep producing income. That's the long-term goal, is for my money to sit there and be productive and grow over time. Because I mean, if you just think about money that sits there for 30, 40, 50 years, appreciating in value, when I die, and pass that on to my kids, that's going to be a significant chunk of money that will, it might not be enough to make it so they don't ever have to work again, but it'll make it so that they'll be able to, to live their lives and do whatever they feel they're supposed to do without worrying about how am I going to pay for it.
So the question is, Dave, I mean, because we're talking about long-term investment, and for those of you that just jump in or in replay, we're talking to Dave Nallett, who is a long-term investor. We are going through his pretty much his M1 approach to investing, which is a long-term investing, and we're talking about that before we hop into the nitty-gritty, actually. But my question is, how do you then realize some of the gains? Do you just take it out? How if 5 years from now I want to buy a house, how do I realize those gains over those time?
Yeah, so I mean, in 5 years, my goal is to not have to touch this. So I'm hoping to just have enough income from my job or from the sale of the current house that I've got or whatever, to fund that. The one thing that M1 does have that's pretty cool, is if you reach a certain level in it, and I believe they just dropped it to like $5,000, you have access to a margin account where you can still collect the dividends and the gains on the underlying securities, but you can borrow against your investments as a line of credit. Now, obviously, that carries with it certain risks, but M1 Finance only allows you to borrow 35% of your holdings. So they do their best to kind of keep you in a safe risk area, and you only borrow it against at a 2% rate. And so when you borrow at a 2% rate, that's and I mean paying for the premium feature. It's a little bit higher if you don't pay. I think it's like 3.5%. But borrowing at a 2% rate, I mean that's essentially free money.
And you're borrowing from your own investment.
Correct. Yeah. And so, I mean, if my investments fell off a cliff or whatever, they would sell off my stocks to pay for it. That's the collateral.
Right.
But I make what I'm actually using it for right now, which is a really cool setup. Is I've got some student loans that I'm paying off, and they're at about a 6% interest rate, and so I'm actually borrowing money at 2% to pay off money at 6%. So I'm making up the money on that, and we actually ran the numbers. Exactly. And so now my money's working for me in a smarter way. And so we ran the numbers, and that wound up saving us something like 5 years, and it was well over 10 grand off of my loans. Or sorry, it was just about 2 years and 10 grand. So there's smart ways to do it. You could use that as a down payment for a house if you had enough in there, or even to pay for your whole house and self-finance your own mortgage, and then you just pay back your investment account over time. So that I would rather do that than sell out of Apple, for instance, because I'm a believer in Apple. I'm bullish in Apple. For the long-term view, their most recent financial reports have done nothing to change that. If anything, it makes me even more bullish on it. And so,
just for those that may not know what you're saying when it's bullish or bearish.
Yeah. So bullish is essentially, I have long-term optimism about the stock price. I think it's going to go up over the long term, versus AT&T with their decision to sell out Warner Media and their HBO assets and things like that. It went up
a little bit.
A little bit today, but
it's it traded at 30. It was I think when we were talking about the sell-off of their thing, it was trading like 26, and it's up at 30. So that's kind of weird.
There's some people. This is again, an instance of short-term irrationality in the market, and you can make some profit on it. It's not something I'm inclined to do, just for my own risk tolerance. Peter Lynch says that the most important. And if you don't know who Peter Lynch is, he ran Fidelity's Magellan Fund, which put them on the map. Peter Lynch beat the S&P 500 for all 13 years. He ran the Magellan Fund, and he returned an average of 29% annually. So he is considered one of the greatest investors of all time. And Peter Lynch said that the biggest the biggest instrument when it comes to success in the stock market is not the heart, it's not the intellect, it's the stomach. How much risk, how much volatility are you willing to take? Are you willing to handle? Are you willing to sit there in a down period and buy a stock? And just because you believe in it long term. For instance, one of my holdings, if you look in the pie, the industrials pie, LMT, Lockheed Martin, they provide a lot of aerospace defense and things like that. I started buying them, and they were up in the 370s or so. And they started dropping into the 330s,
Where did you say the industrials? You said
Industrials pie. Yep. And so they dropped into the 330s. That's that big dip in there, right? Mm-hmm. But there was no fundamental reason for the stock to go in. They actually had billions of dollars in contract on a back order. They were producing free cash flow. They actually were increasing the amount of the dividend they were paying out to their investors.
This is Lockheed Martin.
Correct. Yep. And they were increasing the amount they were paying out to their investors, while they were also, what's it called? So they were increasing what they were paying out to their investors. And if you go back go to the 1 year clicker on that up on the top, you'll see it over the year. So if you look around October and then it dropped big into December, they were actually reducing their debt, increasing their free cash flow, and paying out more money to their investors, while reducing their payout ratio. And so everything, when you look at their cash, you look at their debt, you looked at everything. Financially, the business was set up to succeed. Their enterprise value, to their earnings had gone in a positive direction. So I had started buying around 370 or so. And when they dropped in, into the 330s and 320s, I started buying hard, because my whole thought is, again, as a long-term investor, I'm not focused on the short term. I'm looking at it as, how is this going to benefit me here in the long term? So I believe this is undervalued here at 324 in the 330s and the 340s. So I buy. That lowers my cost basis. And now when it skyrockets up, all of a sudden, not only do I have, the gains from the stock, there's also a term in the investment community. If you notice there's a field there referred to as dividend yield, right above the watch button. It's at 2.55%, and that's the dividend yield, based on the stock price and things like that. But if you buy at a lower rate, you actually have what they refer to as a yield on cost. And so my yield on cost is higher because I'm going to get the same payout from Lockheed Martin, whether I buy it at 320 or 390. Nice. So if I can buy a company I believe in at 320, and now it's 390, my yield on cost is much higher than somebody who's at 390.
So let's address the newcomer and that is looking at a company. How are you looking at this? If you can step back when you September, October, what was your kind of like your notion or your predisposing pattern to enter into a trade or into an invest?
Yeah. So, really the reason why I invested in them, and this is something that a lot of dividend investors do, and you can still kind of see from my setup here.
If I could jump in a minute, for those of you that are going to watch this and probably on replay, for M1, you actually choose individually the shares or the stock or the company that you're going into. Although there are abilities for you to just join in somebody that like Dave, who is turning a 45% increase in his investments. You could actually just click on Invest Pie, and however much money you're putting in, it will divvy up per the percentage that Dave is in. Is that correct?
It is, but it's important to note that it's not dynamically allocated. So if I make changes to it, which, I've done, like the ETF section of the pie is now just a much larger section, because honestly, number one, like I indicated, it's hard to beat the market over time. Number two, it's hard to do this deep level research on these companies, and I just don't have enough time to do it for 30, 40, 50 holdings. So I'm down to about my 12 or so companies. Besides my cruise plays are the closest thing I have to a swing play. It's my COVID recovery play, because I believe I really think once they start showing that they're making some money again, their books will go up again. So I'm buying in, and I want them to keep going down right now, because I think once they start making money and sailing again, they're going to shoot up, and then that's when I'm going to sell out of them,
just
because it's not a long-term hold.
All right. Oh, this one, right? So more, this is a growth position.
Correct. Yeah. And I allocate, little bits here and there if I think there's an area that's undervalued or where I can, invest in something like that. But the majority of these, basically everything but the cruising plays are my long-term buy and hold, I'm going to sit there and I'm going to collect my dividends every month, every quarter.
Very cool, man. And just to let everybody know, ETF are actually a conglomerate of businesses coming together, and it's being run as a fund.
Correct. And there's so if you look there, there's actually, and we'll get into a business here in a second. But if you look at the ETFs, I've actually got 4 different ones in there. And you might think, well, why are you holding 4 different funds? These are actually, every single one of them is 4 different strategies.
Right.
And so
that you're diversifying even within the diversity that you chose.
Correct. So I'm holding literally hundreds of companies within these 4 funds. And so the SCHD is the Dow Jones Dividend 100 Index, and then they have a weighting methodology they use that's really, really fascinating. If you want to hold a fund, you've got to look at the methodology. You can look at past performance, but past performance is no indication of future results. So SCHD is that. STK is one that I found recently. And they actually trade options and puts against the NASDAQ QQQ.
Which one is
basically, this? STK. Columbia Seligman. If you go down, it's Columbia Seligman Premium Technology Growth Fund. And so they sell...
So they're a fairly aggressive of a fund. That's what you're saying.
Well, so
options and puts and all of that stuff.
They do options and puts against, I believe their long-term goal is 55% of the positions in there. It could be as high as 90% one month and as low as 20% the next. But their whole goal in that is to then return capital to you as the investor, while also ensuring that you don't miss out on the growth over time. So they're returning 5.7 or 5.47% a quarter. And then they also, I did a back test to about 2011. And when you reinvest the dividends that they're paying out, you're actually keeping pace with the QQQ, which is one of the most aggressive growth indexes there is. It was within a couple $1,000s difference.
Just for those that are kind of figuring it out, remember that your bank is returning to you maybe a 0.003% or what have you.
Right.
So this ETF is actually returning to you 5%. So if you put $100 in the bank, you'll get maybe 3 cents, and this you'll get $5. So that's
plus you'll also realize the capital appreciation from it if you ever did decide to sell out. I mean, if you look over the history of this fund, when you reinvest the dividends in it, that's where it really begins to compound, because now I'm buying additional shares. This is just a day right here, but when I reinvest, my dividends in here,
you're doing that automatically, Dave? You're reinvesting auto?
I do it manually myself, just because I want to find the value. That's one of the things that I've learned is the only way to make money in the market is to buy things that are undervalued and produce cash. That's when it comes to high growth companies with a lot of debt.
I think I'm getting what you're saying.
I don't really know how to value that. But if you're producing cash, you're either reinvesting it into the business and buying back shares, which in turn drives up my share price, or you're paying me out money back as an investor, or you're doing both.
Yeah.
And so that's why in my Roth, one of my favorite funds is it's called COWZ, COWZ. And it tracks I don't have it in my taxable account here, but it tracks literally the 100 companies in the market that produce the most free cash. And it buys those because those are companies that are typically going to do well over time because they're productive and they're profitable.
So the idea really is just for reinvesting of the dividends that you are receiving. Now, again, the dividends is the payouts of the company for allowing them to use your money, so to speak, and for holding for
being an owner of the company, yeah,
a partial owner of the company through their stock. The idea really is they give you this dividend and you put it back in, and now you're kind of in a certain way you're using their money to buy shares of their company. And if you continue doing that over the years, then the amount of money that the company has been giving you, you increase your dividend share or the amount of stocks that you have in the company. And if you pay out 10 years from now, if you invested in one stock, 10 years prior, you might have 100 or 1,200 shares, depending on the dividends and the way the market flows on how much it is.
And what else you've added to it, and things like that. And that's the goal is I'm not looking for money now. I'm looking for money in 10, 15, 20, 30 years. So that, what's it Dave Ramsey always talks about, you eat beans and rice now so that you don't need to be eating Alpo when you're 90. But if you go back to the pie here, there's two other funds here that are kind of cool that are, again, just different ones here. The first one on the ETF is DGROW. It's the dividend growth ETF, and so they invest in companies that aren't in the dividend 100 index. These are companies that they've looked at the market and they're now reinvesting their dividends, or they're growing their dividends over time. If their dividend yield gets too high, they're gonna cut them out because they're saying that's a risky play. But if you're a safe company that's producing dividends and growing it within reason in a reasonable manner, they're going to keep them in there, and the amount of money that you're going to get is just going to continue to increase over time. And then the other one I hold is called JEPI. It's a fairly new fund from JP Morgan. And again, this is another income producing fund. What they do is they write covered calls on the S&P 500. So this is a different index than the other one. So this is the 500 largest companies in the U.S. stock market. And so what they'll do is they'll write covered calls against the S&P 500 up to, I believe it's 80% of their assets. And their goal is for you to be able to realize the majority of the capital gains, but also provide you a solid monthly income, whatever the premiums are that they generate from those funds.
Very cool, man. This is very. Thank you so much. I don't know if we have the time to look up your. Maybe we'll split it and take this 30 minutes, and we'll jump in another time. What do you think? Because that's a lot of information.
Man, we're good.
That's a lot of information, and we ran through a little bit of the M1 structure, but more so, it's a good. It's not a basic intro. I think it's not to put a shade, but it's a fairly starter type of intro. I think you did a great job, Dave, of giving those of us that are novices an idea on long-term investing and how one company can provide for you a sustainable growth over time. But not only that, but it can give you money for holding its equity or its shares, and then over time, as it grows, the company grows, and as you put in more of the dividends, you can actually have growth play and come out a lot more wealthier in 10 years than when you started. You started $100, you might be up 10 grand, 15 grand, or maybe even more, depending on how strong the company is.
I mean, I'm in a Discord community, which is where I've learned a lot of this. From I'll give a plug to one of my favorite YouTube channels, the Joseph Carlson Show on YouTube. He's very much a long-term dividend growth investor. He shows you how his portfolio does every week. He shows you, what gains he's gotten, how his dividends are going, and things like that. And so there's a whole group of us on his Discord there, and there's people in there who are literally making $2,000, $3,000, $5,000, $10,000 a month in dividends, and it's rolling in. There's some of them who've been doing this for a long time, and just compounding their money, aggressively investing. And there's literally people in the group who've quit their jobs and they're just living on their dividends, and they still hold the companies. They just sit there and those checks roll in every month, every quarter, whatever the case is. And the whole idea here is, again, long-term, like we said in the beginning, the market's irrational in the short term. It can go up and down. It can go up and down. It can do all sorts of crazy things. And there are people who are able to profit on that. I know Tyrese made money doing that and things like that. And that's just, for me, that's not my speed. It's too risky for me. That's just my personal tolerance, and everybody's got to find what their own thing is. I would rather put money into Apple and buy Apple, and I know in 10 years, based on their cash flow, based on their revenue, based on, you know, everything, which we'll talk about in another video, I know Apple's going to be worth more than it is now in 10 years. You know, so it's just for me, it's what works. And so I don't know if there's any questions kind of about the style, the strategy, the thought process.
There'll probably be questions that come up on the replay of this, because nobody's watching us right now. But the information that we have is there in the group, and people can turn it. And it's a 30-minute video, so it's digestible. So we'll keep it at that. And man, I know you. Let's just show the people what we had intended, and so that was not it. Where is it? There. Let me look for it. Here. Let me see. Let me see. I think we have to get into.
You need to stop and restart it.
No. You're good. So that's what we're gonna look at, and let me just go and make this happen for just a minute. Hold on. Let me see. Where'd you go? I'm actually working out oh, there it is. Hold on. That's what it is, bro. That's what it is. Okay, hold on. And we'll keep this on as a. There you go. And now I got it back in there. I'm actually looking at it in the background. So, but this is what we're looking at, and I'm going to show Dave's screen here. There it is. That's what we're going to be
zoom in here real quick. Yeah, this is where it gets fun. You know, this is all just diving into the numbers.
This is what you call nerding out. This is what you call nerding out.
Well, and this is where you find the value. This is where you find, you know, if you look here, historically, they're actually Home Depot's trading a little bit over their historical value here. But, you know, when you look at their numbers, we've got cash flow, expenditures, their debt, free cash flow, number of shares. You can see they're decreasing this.
This is a spreadsheet of the company's earnings and things of that nature.
Correct. So what I've done here, and I've used Macro Trends, which is a great resource. Macro Trends has revenue, profit.
Don't get into it. We'll talk about it in another live.
It's got all of it, but yeah. the whole point of this, I'll give you the sneak peek here. The whole point of this is to look at the numbers, look at the numbers, and use what I'm doing here, and I'll break all this down later on. Is to look at the numbers to forecast potential future value, and then when I take the future value, you also there's one thing to look at the numbers, but the other thing is you have to look at the story behind the company. So this is the quantitative side, and then what's the qualitative side? What's the story? What's the company actually doing to generate these profits, to do these things? Are they trending in the right direction? Are they trending in the wrong direction? And then we'll produce what we expect the stock price to be in the long term based on the value. This is obviously minus any share splits, and based on whatever the case might be. Obviously, going from a 264 when I did the sheet down to 557 is pretty good. So
that is the teaser, Dave. Let's let them salivate a little bit, get them excited about the next time you show up.
Now that's a 10-year time horizon, mind you. So we're talking 10 years to let that sit and grow and let them keep paying me cash while I keep holding.
Hey man, I'm not against it. I'm not. How old are you? If you don't mind me asking.
33. So
at 43 years old, we're talking about a realization of gains that what you're hoping for. This is
well, possibly. If depending on what the story is in 10 years, depending on what the company's trading at in 10 years, on their value, on how they're doing revenue wise, I might want them another 15, 20, 30 years. I don't know. It just depends on, are the numbers in the story, are they still positive? Are they still in sync? Do I still believe that there's value there in the company going forward? And if there's still value there in the company, there's no reason to sell, because they're going to be worth more in another 10 years and in another 10 years and so on and so forth. So I'm going to keep holding it, let them keep paying me, and pass that on to my kids if they're still there.
Well, that's just one smart man. Dave is one smart man, y'all. So if you guys want to, Dave, do us a favor and drop those Discord informations that you shared and some links that you may have underneath this video in the comments so that people can follow you.
I'll drop the M1 link, and then the Discord is actually.
We want to, if I may, we want to encourage everybody to use our referrals. A lot of these apps have referral systems. So if you're coming into it brand new and this is your first download or what have you, make sure that you join through one of our members' referral so that we can share alike, right? And be a blessing to one another. So make sure that
so what I'll do for the Discord there, that's actually via a Patreon for the Joseph Carlson Show. And so I honestly have gotten so much value out of the Discord that I would pay double what I'm paying, because it's taught me how to look at companies with a long-term view, how to value companies.
Well, that's what I want to jump in here.
So I'll drop it in there for you.
Wait till you do the Patreon until Dave does his own Patreon. All right. So you guys take the information from Dave, and then Dave in the 3 months or so, when he feels confident about it, he'll create his own and bring value to everybody so that he can have some more money for his babies come 10 years, 20 years from now. Because you know what he'll be doing with your Patreon monthly fee. Yeah, you know what he's going to be doing. So anyhow, until next time, man.
All right, man.
Give them a Dave word of advice or encouragement. I know you're going to make it up right now.
Man, don't let short-term irrationality scare you out of a good investment. If you believe in a company long-term and the stock's falling hard, buy it. Disney's fallen off the last week after earnings, after they didn't meet the Disney Plus subscriber numbers, and I'm bullish on them. So buy the dip if you believe in the company long term.
Yeah, and we're gonna talk about that in another 30-minute drop-in video here at WL Investing and Finance. So until next time. Do your own research.
Dude.
See, he doesn't want to say dummy. He says dude. Okay, I'm with that. Yeah. I'm with that. Do your own research. Do your own research. D-O-R-D. All right. Peace.
All right.